Well, clearly I was wrong to trust Celsius, and I'm confident admitting that now because they have just admitted to everything that went wrong in their bankruptcy filing documents. There's some pretty nasty surprises in here, but there's also some silver linings. So we're going to take a look at it today and see exactly what happened with Celsius and what is coming next. So this document was released on July 14th, about 2:00 p.m. And this is a declaration of Alex Mashinsky, who of course is the CEO of Celsius Network. And this is pretty much discussing everything that happened from Celsius's start as a business to what led to them filing for Chapter 11 bankruptcy. Now it starts off kind of slow, just explaining what Celsius does. They kind of explain how there wasn't really a platform before for users to earn yield on their crypto and benefit with these weekly payments and all that kind of thing without having to sell off their crypto. So they saw themselves as kind of a first of its kind solution to do this, and it started off pretty smooth. Of course, as we know, they have a pretty vague terms of service, and we're reminded of that here, that we transfer all right and title of our crypto assets to Celsius when we deposit onto the platform, giving them the right to pledge, repledge, hypothecate, rehypothecate, sell, lend, or otherwise transfer or use any of the crypto we have stored in our Celsius accounts. And this even includes the right to use or invest crypto at Celsius's discretion. In the next couple of sections kind of give some more details on how they offer rewards, how the platform launched, and how it's kind of grown in the last couple of years, which we're going to dive into more here in later pages. But first we have a big section on the events leading to the Chapter 11 bankruptcy filing. They say the early success was not without hiccups. They've learned a lot of lessons from the beginning of starting Celsius. They accumulated more assets on the platform than they expected, and more than they were prepared to deploy because it was just growing so fast. And here they say they made, in hindsight, what proved to be poor asset deployment decisions, many of which we have figured out in the last couple months. They also admit that they suffered other unanticipated losses, and they started making significant changes to the business model in order to try and make up for some of these losses. Of course, some of this was aggravated by things like the COVID pandemic, the implosion of Terra Luna, and then following that, there was an industry-wide reluctance to do business with companies like Celsius that held crypto assets. And Celsius says this was exacerbated by negative social media campaigns about Celsius, many of which were unsupported and misleading. And I covered a few of these in videos a couple weeks ago probably, but there were just so many headlines coming out that were just seemingly unfounded, just to get people scared about Celsius and pulling their funds out, but in hindsight probably weren't too far off from the truth. And of course all of this led users to withdraw crypto from Celsius in large amounts at a rapid pace. And this is where Celsius got into problems, because a lot of their crypto is tied up in long-term and illiquid crypto deployment activities. This includes loans to third parties, and this is a really interesting one here, including some assets that had been pledged in support of borrowings or sold to generate cash, which was used to acquire Bitcoin mining equipment and the GK8 storage business. So Celsius directly took users' funds, sold them to buy this GK8 storage business and grow their mining business, which is just crazy to me because we had no idea that that was the case. That was where this funding was coming from. You know, if I knew my money was going into Celsius to buy Bitcoin mining equipment and other companies, I probably would have treated it a little differently. And of course, it got to a point where Celsius kind of reached a fork in the road where they couldn't both meet the demand for user withdrawals and provide collateral for all of the things that they had borrowed against. And of course, this led to pausing withdrawals and then discussions with legal parties to figure out the next steps forward. And all of these discussions led them to believe that an in-court process would be necessary in order to return the most amount of funds to users in the most fair way. And a silver lining here, which again we'll talk a little bit more about in a minute, that Celsius has closed or unwound nearly all of its outstanding DeFi loans and counterparty loans to bring their collateral back under control. So at least something is going their way for now. Now this is the big one right here. It's their declaration of liabilities and assets. Liabilities, of course, how much money they owe, including how much money they owe to users, which are people who have deposited their funds on the platform, totaling $4.72 billion. Of course, they do have some other liabilities here, which total $5.5 billion in all. Then we have their assets, cash, crypto assets, mining assets, which is super valuable. We'll talk a little bit more about that too. And they include Cell Token here, which is kind of tricky because they value it at $600 million. But if we look at the market cap right now, it's only valued at about 190 million. And that's because the majority of the remaining supply is like locked up on Celsius. It was not intended to be released, sold on the market, anything like that anytime soon. So realistically, if they were to dump all of those tokens on the market, it would tank the price. There's no way it would hold that $600 million valuation. So that's a kind of a tricky thing. I don't know how they'll handle that. Maybe there's a way to keep the value kind of pegged around that point and find a third party to buy the supply or something. I'm not really sure. I'm not an expert there, but it's kind of strange that they can include a 600 million valuation on the Cell token balance here as part of their assets. But anyway, moving on. This brings the total assets they have to $4.3 billion, which of course is about a $1.2 billion deficit between the assets and liabilities, which means they need to make up $1.2 billion to settle all of their debts. And that is a pretty big gap. So the rest of the document gets a little more into detail about all of the things kind of introduced in the beginning here. So I'm going to skim through some of it and highlight the important stuff where we need more detail. This first part just gives some more background on Alex Mashinsky and kind of his professional experience and how he got involved with Celsius Network, which I don't think is hugely important, so we're going to skip to the next part. And here it is broken up into 4 different sections. And we're going to go through each of these, except for the first one, because the first one is just an overview of the cryptocurrency market. Hopefully, if you're watching this, you understand crypto. It's basically just explaining what Bitcoin is, how a blockchain works, what is DeFi, and stuff like that. Then it goes into the company's history and business operations, a lot of insights there. Then their corporate structure, and finally, an overview of exactly what happened that led to the Chapter 11 bankruptcy filings. So here we go, we get a brief overview of Celsius's history starting in 2018. Of course, they started off pretty small and did grow quite rapidly. 2018, they had 50 million in assets. 2019, 200 million, so that's a 4x from 2018 to 2019. And then by 2021, they passed 10 billion. Which is just crazy how quickly money was flowing into the platform. And for all that time, the inflow of assets into Celsius outpaced the withdrawal of assets from Celsius, which allows them to keep running business as usual. Here we have a little chart showing the inflows and outflows over time. And you can see towards the end of 2020, beginning of 2021, is when Celsius really started ramping up their assets under management. And interestingly, they slipped into a deficit here around late February to March, where the withdrawal started exceeding the deposits on a monthly basis. And of course, May was the worst right here. And here we get into the company's operations, which shouldn't be much of a surprise. It's all of their services they offer to users, yield, loans, sell pay, swaps, and Bitcoin mining through their mining subsidiary. But here we get to the retail lending section. And this stuck out to me because in previous AMAs, they gave the impression that when you took out loans against your crypto, they kept that crypto, on hand and secure because you were borrowing against it. And if they did something with it, then they loaned out money and they used the money you gave them as collateral, and there's nothing really to protect them there. Come to find out, any assets you posted for collateral as a loan, Celsius is then entitled to rehypothecate those assets. So they might not have necessarily been keeping those loan collateral balances in kind on hand as we were led to believe. And currently there are still 23,000 outstanding loans worth about 400 million that are backed by collateral worth approximately $760 million. Next is the institutional lending, and I want you to remember this Celsius Network Limited. This is kind of the branch of their business structure that deals with these institutional loan customers through a separate business entity. And again, there was a couple AMAs I watched. I read a few articles that were directly quoting Alex Mashinsky, and they said that Celsius does not provide unsecured loans, meaning they always require collateral for these institutions who are looking to borrow funds from Celsius. And they often said they required much in excess of the loan value requested, which means for every dollar that Celsius lent out, they should have received at least $1 of collateral to back that up just in case the loan party defaulted. Right here, it says depending on the creditworthiness of that counterparty, Celsius may provide institutional borrowers with either secured or unsecured loans. Unsecured loans, of course, are backed up by nothing, $0. So this is just another point where we could have been outright lied to, or at least the truth was a little disguised through the way they presented it, where they were taking a little more risk than we were led to believe, which was supposed to be their primary business model, the transparent business model, the safe business model based on their operations. And again, just a little more risk than we expected. And this makes it look a little worse. Currently, there are $93 million of loan distributions out there owed back to Celsius, and they have collateral worth approximately $98 million from the borrowers who took out those loans. So that is barely one-to-one coverage for these loan values, which again is like shockingly low, especially compared to the retail balances, which had almost a 2x, spread between them for some serious buffer in case these retail payers didn't back it up. These institutional borrowers, again, almost one for one, not much wiggle room here if something went wrong with the collateral or with the counterparties. And again, we were led to believe that this lending model was their primary business model. This was their main source of generating yield for customers. But there's only $100 million of outstanding loans. Maybe over the last couple of weeks, they've been really aggressively reeling these loans back in. Maybe that's part of their unwinding process that they've been doing, because it's kind of alarming that the institutional loan balance currently is a quarter of the retail loan balance. And retail loans are paying very small percentages because Celsius was so generous with their rates on consumer loans. But so this is obviously just a red flag that we did not see coming. Next up, we have the custody service, which was offered just a few months ago because Celsius was required to stop paying interest to non-accredited investors in the US. So they created the custody service. You could store your coins here, still have them safely on Celsius, but not earn any rewards on them. And this is somewhat comforting because they told us when this product launched that these coins that you put in your custody wallet will not be moved, loaned out, rehypothecated, whatever. They will remain on hand and readily available because they're not going to do anything funny with those funds because they're just holding them for you in custody. And it looks like they did hold true to that, which is good to see at least. But there's still a pretty small amount in these custody wallets, just about 180 million as of a couple of days ago. This next section is just about using the platform and what the app provides to you. And then we get a little more into the pause. And it says, though the company removed certain features from the app, some have continued to transfer their assets onto Celsius, mostly for the purpose of posting additional assets to meet margin calls for these loans. But despite this pause, users have continued to transfer assets and may continue to do so. So, I mean, I don't know why you would continue depositing into the app. We have no idea when withdrawals will be available, unless you're paying off a loan, adding collateral. And even then, I don't know, man. I've got some loans open and I feel really dicey about putting more money onto the platform to maybe see it never again, maybe see a fraction of it again. So it's really tough right now to feel good depositing more assets onto Celsius. But some people are doing it, and there's the proof right there. All right, but next we have to get into the Celsius Mining LLC, which is a crazy kind of situation going on here. In addition to their Celsius lending, borrowing, yield model, the company has invested and created one of the largest crypto mining enterprises in the United States. But very important here, the way they did this is through Celsius Network Limited, which again was that institutional borrowing subsidiary of the Celsius Network company. They entered into a revolver facility with mining for up to $750 million. So this is $750 million of user funds that were made available to their mining subsidiary to invest in mining equipment and start mining Bitcoin, which again was never made clear to us. They boasted this mining business as, oh, we mine, we've got one of the biggest Bitcoin mining businesses in the country. We mine so many Bitcoin, we're going to use that to pay yield. Little did we know, we paid for the mining business. Again, it's a long-term investment in mining that they expected to generate yield for the company. And they believe that over time, it will generate sufficient assets to repay that loan. And then Bitcoin will provide additional revenue for the company in the future. Now, this is pretty cool. They own 80,000 rigs. About half of them are operating already. And before this, they plan to get up to 120,000. So I imagine they probably won't, given the current situation. But with this, they're generating about 14 Bitcoin per day. And that is almost 2% of the daily Bitcoin mine. There's about 900 Bitcoin mined a day. So that is a large share of the Bitcoin daily mining. They're expected to generate 10,000 Bitcoin this year and approximately 15,000 in 2023. And currently, of that $750 million credit line available to the mining business, they've taken out $576 million. So that's nearly $600 million that Celsius sold of users' funds to invest in mining that still needs to be paid back by the mining business. And 14 Bitcoins a day, still only about $250,000. So it would take a long time for this to be paid back at current prices, at least. Next, we have another pretty alarming section about other deployment activities. Again, I think Celsius said many times in their AMAs that, we aren't very involved in DeFi, we don't invest, we don't take positions, we only lend, and we have a Bitcoin mining business, and that's what we do. Come to find out, there are a lot of other ways that they were deploying funds without us really knowing the extent of it. Of course, one of these is DeFi and lending protocols, from which they would borrow US dollars against the collateral that we essentially deposited into our accounts. Now, before the bankruptcy filings here, they had about 650 million in loans on DeFi, with approximately $1.6 billion in assets. And it lists them all out here. These have kind of been in the headlines recently because they've been gradually paying them off. And as we know here, all of these DeFi loans were repaid by the company and the collateral was returned. So at least they got that sorted out. And they also had a loan on FTX of $108 million collateralized by $400 million of assets. And currently all of this has been unwound and paid back, except for one loan of approximately $3 million with $6 million in collateral. So pretty small in comparison to the kind of moves they were making before this. They also started staking, perhaps most infamously with staked ETH, where they used the Lido Finance DeFi protocol to exchange ETH for staked ETH, which they could then further lend, stake, or trade. Of course, the big problem here is it's pretty much illiquid until the Ethereum merge happens. So they are earning a yield of about 5% on it. It's pretty much locked up, and at some points trading for less than Ethereum's market value. So as of the 10th, they hold 400,000 staked ETH, which is approximately $470 million worth of the company's ETH or users' ETH. And again, illiquid, but earning approximately 5% until the merge. Next is exchange deployments, which they did discuss quite a bit, primarily through funding, which basically they just allowed exchanges to use their asset volume and paying Celsius a fee. That's kind of what I interpreted their main exchange strategy to be. But as we see here, there was a little more going on with exchanges. One of these is swing trading, which is straight up taking positions in things and betting on the markets, which they said several times that they don't do. Of course, this is not market neutral. They were taking positions here in order to profit. It does say they set narrow risk limits and stop loss mechanisms to kind of limit the risk, but it doesn't change the fact that it was still going on when we were led to believe that it wasn't. Furthermore, they were just straight up trading, spot trading. They kept assets on exchanges to be ready for immediate transactions. They say this was more a hedging strategy rather than an income generating activity, but it still comes down to them having to time the market in order to try and hedge different movements, which, no one's going to get that right 100% of the time. So it's tough to rely on them to do that when I would have preferred they just held an asset and kept it in that asset. And an interesting note here, we know that Celsius is continuing to operate during this time. That's what this Chapter 11 filing is for. It gives them some space to continue operating and kind of plugging some holes and sorting things out without having to take any drastic actions. But it says they do not intend to continue engaging in exchange deployments in the near term. So that's going to limit what they're going to be able to do to generate revenue while they kind of dig themselves out of this hole. There's a quick note on GK8 here, which of course is the custody solution business that they acquired in 2021. But it says, to this point, they had not been able to integrate any of their operations into Celsius because they've been so focused on dealing with their own liquidity issues. But they insist the GK8 is still a valuable asset, and they are exploring marketing and sales of the GK8 business. So maybe they'll keep it on and integrate it with Celsius, or maybe they'll just sell it and try and get some more cash to balance out their liability situation here. All right, so now we got the last two kind of most important sections, what led immediately to the Chapter 11 bankruptcy filing and what could be next. So right here, plain and simple, they blame it on rapid growth, business losses, and a failure to properly transition the business. Again, in hindsight, asset deployment decisions were made that proved problematic. While they tried to unwind the deployments, the damage was done. So here we get into a list of these issues, starting with Stakehound in 2021, who had misplaced the keys to over 38,000 Ethereum tokens, 35,000 of which were Celsius. So that was just a straight up 35,000 Ethereum loss. And there is legal proceedings going on there to kind of try and remedy that, but that's a big chunk to lose. That's going to be about $43 million at today's prices. But it gets worse. To support its operations from 2019 to 2021, the company took out collateralized term loans from a private lending platform. When Celsius attempted to repay one of its loans, it was informed that the lender was unable to return the company's collateral. So this resulted in Celsius losing approximately $500 million of collateral against this party because they just couldn't pay it back to Celsius. Now the good news is the company has made regular payments since September 2021 and continues to make payments of about $5 million per month. Of course, it would take a long time to go from $5 million a month to get up to $500 million. So as of now, the company still owes Celsius about $439 million. But at the rate of $5 million per month, it's gonna take a long time to get this back. And that's money that Celsius could have been using to pay back users and settle some other debts. But they just took too risky of a loan here using this private lending platform. The next issue is prior to a crash in 2022, the company was evaluating its business model because they knew it wasn't sustainable. And I think they kind of started to see that they were accumulating too many liabilities and debts and they didn't have enough assets on hand. So what they did is they borrowed stablecoins to fund purchases of crypto to align the magnitude of crypto assets to crypto liabilities. So it sounds like they have used their crypto irresponsibly, and then they decided to borrow dollars and invest it in more crypto to level things out and make things right. And I feel like every single AMA, they said, don't use leverage, don't borrow money to invest in crypto. And they did exactly that to try and hide the mismatch of their assets and liabilities on the balance sheet, which is wild. But they say they were learning from their mistakes, and in the first half of 2022, they were on track to introduce a more sustainable business model, doing things like moving away from the no-fee model and decreasing the rewards rates that they paid on the Earn program. And they believe that they would have succeeded in the near future if the market remained stable. You know, they said many times, we've been around bear markets, we know how to operate in bear markets, and it shouldn't have come to this to end them. I think if they were doing things right, this wouldn't have happened. So it seems a little convenient now to just blame it on the bear market when in actuality, they were using strategies that weren't sustainable. The next section, they blame market conditions. This includes COVID-19, quantitative easing, new variants of COVID-19, sell-offs of risk on assets, a possible recession, you know, the Ukraine invasion, Federal Reserve increasing the funds rate, and basically just all these economic fears that kind of led to a sell-off in crypto, just kind of all of the stars aligning for Celsius to get hit hard. Next is the so-called crypto apocalypse, which kind of started with Terra Luna, leading to a big sell-off in crypto assets and further downfall of other crypto platforms. Again, Terra Luna exacerbated the cryptocurrency winter, and they list a bunch of people who were affected here by that and the following events. This next section highlights the Terra Luna collapse specifically and highlights kind of what led to it and how the Terra Luna system worked. But the important part here is that the company says that when Luna started to depeg, they withdrew all of their UST and suffered only a relatively minor loss of 15 million, which to be fair is very minor compared to what other people lost during that collapse. But again, there were so many times where Celsius came out in AMAs and said, we have no exposure to Luna, no exposure to UST, we're totally fine. When, I mean, a $15 million loss isn't huge, but I think they could have probably at least stated that, hey, we were exposed, but the loss was small and we were able to get out early thanks to our risk management. Instead of saying, oh, we're good, we didn't even touch it in the first place. This led to a domino effect, of course, across other platforms, and they named 3 Arrows Capital here, which was the big one. Now, I don't remember if Celsius claimed to have any relationship with 3 Arrow Capital here, But it turns out they do have a 40 million claim right now against Three Arrows Capital. They love to say, hey, it's less than other companies who have loaned much more to them, which is true. Not that it really matters. It's not helping Celsius's balance sheet. But they extended 2 loans totaling 75 million, and they liquidated some of it, and they now are owed just 40 million from Three Arrows Capital. So it could be worse, but that's still $40 million of missing money that belongs to users. And who knows what's going on Three Arrows Capital, whether they can get any of that back. So I don't remember if Celsius claimed to not have any exposure here, but luckily it is a little smaller, but it is still there nonetheless. Another big issue is the depeg of staked ETH, or stETH. As this kind of happened, many Celsius users got scared and decided to start withdrawing their Ethereum from the platform. And that forced Celsius to sell its staked ETH at a loss, further exacerbating the depegging of staked ETH, which kind of just spiraled out of control for a little bit there. They're also blaming media coverage. They received a lot of negative media attention. Again, much of it was false and misleading. Although, again, in hindsight, probably not too far from the truth. This included rumors that Celsius was going to bail out Luna, which never happened. Statements that Celsius had lost hundreds of millions on Luna, which never happened. It was 15 million. But all of this accelerated withdrawals to $1 billion over 5 days, which is a huge amount of withdrawals here. We get a little chart here to show how that happened. And then accelerated again towards the end here, right before the withdrawal pause. Another thing that accelerated this was Coinbase's filing that said if bankruptcy happens, customers may not get their assets back, which kind of went around. A lot of exchanges, yield platforms, etc., have these kinds of claims. And we all thought, oh, they'll never go bankrupt, and here we are, Celsius filing for bankruptcy. So, hindsight is 2020. Learning lessons for sure. But Celsius continued to provide the withdrawal information, allowing withdrawals, and showing their statistics here with massive outflow deficits for a couple more weeks until they ultimately paused withdrawals. Now here we have the effects on their balance sheet. Of course, the market conditions got worse, false information accelerated withdrawals, Luna and UST collapse, the Cell token declined, all of this creating a reduction of the value of the assets on Celsius' balance sheet, which were largely measured in fiat based on the crypto valuations, which had gone down. Again, summarize, most of these assets are tied up in illiquid investments, including staked ETH and the massive loan to the mining company. So under normal market conditions, Celsius could have supported 100% of customer withdrawals with the ability to support up to 70% over a given week. But with all these market conditions, they came to a point where they had to choose either processing withdrawals or transferring collateral to DeFi protocols and supporting all of its existing loans to make sure that they didn't get liquidated at less than optimal prices, which would of course cause further losses on their balance sheet. And we have some more of these losses here. During the crash, Tether issued a margin call to Celsius with an outstanding $840 million loan. While they had provided sufficient collateral, they agreed to this early liquidation and settlement of the loan, resulting in a loss of approximately $100 million. Eventually in June, the value of their balance sheet fell so much that they lost the ability to borrow stablecoins and the ability to maintain enough crypto assets to match their liabilities. So that kind of caused the mismatch, and that's when they had to do the pause on withdrawals. Now, they understood that the pause would fuel speculation and damage their reputation, at least in the short term, but they still believe that this will protect users the best, as it's intended to preserve all of the assets and make sure that they get a fair distribution of assets back to users, and save irreparable damage to Celsius's business. Time will tell how irreparable that damage is. Now we have the next steps. What is going to happen next? How is Celsius going to get out of this? They hold approximately 4.3 billion in assets. Only about 800 million is owed to non-users. So again, of that 5.5 billion, about 4.7 billion is owed to users. So they only need to make up about $400 million to pay back users. But it's tough to say we'll get priority over some of these other debts. So we'll have to just wait and see. Now, in order to fill this gap of about 1.2 billion, they plan to have a dialogue with the community. They're open to reorganization, to selling businesses, etc., to make up that gap. They say one way they hope to achieve this goal is by using their Bitcoin mining business to continue mining Bitcoin and use that to address the deficit. But as we said, it would take a long time for their 14 Bitcoin a day to generate $1.2 billion of revenue and make up that gap. So we'll see what happens there. But immediately in the near future, they will file a plan that provides users like us, users of the platform, to vote on the next steps for Celsius. Again, this could include selling assets, considering investments from third parties, reorganizing the business, and so on, just to kind of right the ship and let them accumulate a little more money for a little while and make up $1.2 billion. And that kind of concludes the bulk of the information here in this bankruptcy document. We have an organizational structure here if you want to take a look. Kind of illustrates where the mining business fits in and how they're able to loan to it and stuff. But a lot of this is just other information that's not too exciting and not too important. But there we have it. The truth kind of comes out here with the Celsius bankruptcy filing. We know they owe $1.2 billion. They need that somewhere. They have a big mining business that they used user funds to invest in. And it's got a long way to go before it can make up enough money to pay back all of the user funds and all of their other debts. At the end of the day, I thought Celsius was the good guys. I took their AMAs as the gospel truth, that everything they said was to be believed. It turns out behind the scenes, they were doing a lot more that we weren't made aware of. Whether they outright lied to us or just covered up the truth a little bit, it doesn't really matter. It's still dishonest to some extent. Of course, any viewers of my channel know I've been a longtime supporter of Celsius, so it sucks to see that this is what actually happened. Of course, I still hope Celsius makes it out of this for all of the employees who worked for the company and believe they were working with the good guys, for all of the people like myself, like my viewers who've deposited money onto the platform thinking that this was a safe place to hold your crypto. But at the end of this, it looks like you really can't trust anybody with your coins except for yourself. So that is a costly lesson to learn here. Again, hopefully we get at least some, if not all, of our crypto back. I can say for sure I will not be using a yield platform like this again in the future. If withdrawals open up, I will be taking whatever I can out of Celsius and moving it to cold storage. And I think that will be my only method of accumulating crypto moving forward, is keeping it in my own privately controlled wallet. I've removed all of my previous referral links to Celsius and my videos promoting Celsius because I don't want anyone to stumble upon them and think that that information is still accurate, because it is not. But I think this will kind of conclude my coverage of Celsius unless something crazy happens in the future. Maybe some more coverage of these bankruptcy events and seeing how it all unfolds. But I think that's about all I got. So I appreciate you guys watching. Obviously, my heart goes out to anybody who is still have their funds locked up on Celsius. I do hope we all get a solution to that soon. But we learned a lesson, and just got to rebuild and learn from it. So that's all I got. Thanks for watching, guys. Let me know if you got any comments, questions, requests, whatever, and I'll see you next time.